Sir, we are good to start, sir.
Yeah. Good evening, everyone.
Good evening, sir.
See, in last session, what we understood was that the format of financials depends upon the applicability of standards. If accounting standards applies to that particular company, then division 1 is followed. If Ind AS is applicable, then division 2 is applicable to be followed. Okay. Sorry, there was some network issue. Yeah. See, what I was trying to say, that the format of the financial statements depends upon the applicability of accounting standards to that respective companies. So, if division 1, if accounting standards are applicable, then division 1 has to be followed. In case Ind AS is applicable, then division 2 is to be followed. Okay. In case of NBFCs where Ind AS are applicable, then division 3. Okay. Now, in our session, we are learning only division 1 format. However, see, why I am restricting this to division 1 is we are mostly doing non-Ind AS financials. First thing. Second thing is, if you want to understand division 2 format, then first you should understand Ind AS standards. Okay. So that itself is a big topic. There are many Ind AS, okay, around 37, something like that, Ind AS are there. So first we have to learn that, then we can go for the division 2 format. Third reason is there is not much difference between the formats of Ind AS and division 2 and division 1. Okay. Whatever changes are the disclosure and presentation changes as per Ind AS and accounting standard, right? So right now we are discussing division 1 format where accounting standards are applicable. Now, though I am totally focusing on division 1 accounting standards, I still want to give you some brief of Ind AS. Okay. See, there are various boards. See, this is more theoretical, but still please follow so that you will, people who are CAs, well, fine, they will know all these things. But if you are not CA, then it is good to understand. Okay. See, there are various accounting boards which are framing these standards. Okay. In case of accounting standards, they are drafted by Accounting Standard Board, which is constituted under ICAI. Okay. And in case of Ind AS, these are again formed by NFRA, okay, National Financial Reporting Authority, which is comprised under Companies Act. Okay. Why this Ind AS has come is, see, now in the present global economy, not actually now, from 2 decades, there is globalization, liberalization, all these things are happening, right? Because of that, what is happening? Indians are investing in abroad, and also foreign investors are investing in India. Okay. So if you follow your accounting standards, I mean India, whatever accounting standards followed by India, it may not be in line with abroad companies or abroad rules, regulations, and all. So for that, what standards are applicable outside India is IFRS, that is International Financial Reporting Standards. Okay. Either we have to follow IFRS or we have to come in line with IFRS. I mean, we have to get our accounting standards in line with IFRS. Okay. See, there is accounting standard, there is Ind AS, there is IFRS. Okay. Now, IFRS is drafted by International Accounting Standard, okay, board. Whether we have to implement IFRS in India directly, if you say yes, sorry, again, there was some disconnect in the Wi-Fi. Okay, what we are trying to do, I mean, India is trying to do is rather adopting IFRS standards directly for India, they have started phased-wise manner implementing Ind AS by taking whatever requirements from IFRS that matches to Indian environment, Indian economic environment. Wherever it is different, they started putting it to the requirement of Indian economic market. Okay, suppose there is some calculation for borrowing cost, for example. Then if it is in line with Indian economy, then they have, as it is taken into the Ind AS. If it is something different which does not suit our Indian environment, then they started stating it in a different way which matches to our Indian economy. Okay, So basically, there are two standards. One is accounting standards, and another one is Indian accounting standards. That is nothing but Ind AS. Ind AS is nothing but we are trying to implement IFRS in India. Okay, so what is happening by doing this? What is happening? Whichever company for which Ind AS is getting applicable, by default, they are following IFRS standards indirectly. Because Ind AS is nothing but borrowed clauses of IFRS. Okay. And you may ask me, what is this international accounting standards? Earlier, see, there were two boards. One is international. Earlier, there was an International Accounting Standard Committee, which has issued international accounting standards. Subsequently, in 2001, if I'm correct, in 2001, new board has been formed, International Accounting Standard Board, London-based. This, they have started issuing IFRS. But even this new board has not, removed the international accounting standards which were issued earlier committee. They have only made some changes wherever it is required. Okay, and they have retained those standards as it is. So you will find to some extent international accounting standards. And after 2001 or from 2001, on a specific date from when this International Accounting Standard Board has been formed, they call it as IFRS. That is the only difference. Otherwise, right now, whatever the standards we are using, terms we are using is IFRS only. Okay. And another, apart from this, there will be some companies where their head offices are there abroad. Then, though Ind AS is not applicable to them, for consolidation purposes, you have to prepare financials in IFRS standards so that they can consolidate internationally. Okay. Hope you got what I'm trying to say. Okay, this is how accounting standards are, what is the process and all. Okay, this is, I will share this, you can read this. This will, what are the process, how they are issued, what benefits IFRS has got. Okay, I would like to give some brief in this slide. Okay, see, now we have discussed what is IFRS, correct? The same thing what I have told you right now is being tabulated here or put it in a flowchart kind of thing. Okay, convergence and not adoption. See, why they are saying convergence is we have not taken IFRS as it is. Okay, convergence to IFRS in India is Indian accounting standards. This is what I told you. Okay, this is just a diagram form, whatever I have told you. Okay, it is not adoption as it is. We have made some changes. They say carve in, carve out. Okay, if suppose if International Accounting Standard has given 3-4 options to present or disclose any particular item, and what India has done while framing Ind AS is they have chosen out of the 3-4 options. Okay, if these 3-4 options is not applicable to India, then they have introduced whatever applicable to India in the Ind AS. Okay, like that they have done the framing of Ind AS standards. Okay, and difference in numbering. If you see the numbering, IFRS number, if IFRS number is 1, then what they have done, they have just added 100 to the IFRS number so that there is no confusion between IFRS and Ind AS numbers. Okay, if you see Ind AS 101, that means it is IFRS 1. If you see Ind AS 102, that means it is IFRS 2, standard number 2, like how we say accounting standard 1, accounting standard 2, like that. It is the same thing. Only what they have done is to differentiate from IFRS, they have added 100 to every number what is specified in IFRS standard. Okay, that is what I have given here. Okay. Now this is this I have told you what is carve-ins, carve-outs. That means if they have adopted few clauses, few procedures as they are in the IFRS, then it is carve-in, and what is carve-out they have given. If there is any deviation, then it is carve-out, like that they have given. This is more theoretical. You may read it. I will share this. Okay, now I told you that there is a phased manner of implementation. So this was first implemented in 1st April 2015. Voluntary basis for all companies. See, if any company wanted to implement, then they have allowed every company to implement on voluntary basis. Otherwise, mandatory from 1st April 2016. Okay. You see, 1st April 2016, it is mandatory. For whom it is mandatory is companies listed or in process of listing on stock exchanges in India or outside India having net worth of 500 crores or more, where there is a net worth more than 500 and they are in the process of listing or listed or listing in stock exchanges either in India or outside India, then by mandatorily it is applicable from 1st April 2016. This we are talking about Ind AS. See, I have to decide whether I have to go for, why I am explaining you this is because to decide whether I have to go, if you are going for any audit of any company, then how will you know whether you have to prepare the financials in Ind AS division 1 or division 2? Okay, that is the reason I thought explain this to you so that you will have clarity why you are not preparing the financials, and should be a basis for you to start spending. Okay, next, coming to another one, parent subsidiary, whichever you are evaluating is either parent or subsidiary or associate or and a joint venture of any of the above companies, then by default even it has to follow Ind AS only. Now coming to phase 2. Phase 2, that is 1st April 2017, mandatory basis. It is applicable from 1st April 2017. It is applicable to all those companies where the following conditions are applicable. All companies which are listed or in the process of listing inside or outside India on stock exchanges not covered in phase 1. Okay. Apart from phase 1, because phase 1 they have already given mandatory, whichever are not covered above will get covered from 1st April 2017. Okay. Next, unlisted companies having net worth of 250 crores or more but less than 500 crores. So 250 to 500 crores where the companies are unlisted, then this net worth is between 250 to 500 crores. Then from 1st April 2017 by default they have to follow Ind AS. Parent, subsidiary, associate and joint venture of above. Okay. Companies listed on stock exchanges not required to apply. This is a small medium exchanges. Okay. Then they have to by default follow Ind AS. That is from 1st April 2017. Once Ind AS are applicable, an entity shall be required to follow the Ind AS for all the subsequent financial statements consistently. So, say, for example, any 1 year, the above conditions it is satisfied and you started with Ind AS. Then whether this particular condition is satisfying or not satisfying, once it is getting satisfied in any of the years and you have prepared the financials under Ind AS, then throughout the life of the company you have to follow Ind AS only. That is what this point says. Companies not covered by the above roadmap shall continue to apply existing accounting standards notified in Companies Accounting Standard Rules 2006. This is once if the above conditions are not getting satisfied, then you have to follow accounting standards. Another one, companies once required to comply with Ind AS shall apply to both standalone financial statements and consolidated financial statements. Okay, both the cases, if suppose standalone and consolidated, then you have to follow Ind AS only for both the formats, standalone and consolidated. Okay, so you have understood briefly about Ind AS, right? See, Ind AS is nothing but IFRS standards converted to Indian accounting standards in line with Indian economic scenario. That's all. There is nothing difference. Only you may ask me, sir, some companies we prepare financials for under IFRS also. Yes. See, under IFRS you have to give financials when that companies holding companies in abroad and they have to consolidate. It is going under consolidation, okay, in a foreign company. Then obviously you have to give the numbers in IFRS. Whether Ind AS is applicable or not for you, for consolidation purpose, they have to take it under IFRS only because they follow IFRS standards. It is International Accounting Standards, right? Understood? Now I am coming to division 1. Okay. I have told you about Ind AS now. Okay, what are how the standards are formulated and where Ind AS is applicable. Then you have to follow division 2. Okay. Now we are coming to accounting standards for corporate entities where it is applicable. Okay. Now, see, accounting standards will apply to both corporate entities and non-corporate entities. In this present session, we are learning corporate entities where accounting standards are applicable, and we have to put our financials, put the entities financials under division 1. Okay. Right now, we will understand how, in what way it will apply, how these accounting standards will apply to corporate entities and non-corporate entities. Then we will go to division 1 financials. Okay. Coming to corporate entities, the applicability of accounting standards, they have given in the applicability statement saying that it is divided into 2 parts. One is small and medium-sized companies, that they call it as SMCs, and non-SMCs. Okay, non-SMCs, it is very clear. Companies not falling within the definition of SMCs or non-SMCs. Then we have to understand what is SMCs. Okay, non-SMCs is very simple. Which is not SMC, that is non-SMC. Okay, if you see this SMC definition, okay, I think I have not given SMC. Okay, sorry, I have not put the slide. Maybe I have deleted, I don't know. I have not given the SMC definition here in the slide. 1 minute. Yeah, this is the definition which is given for SMC. Small and medium-sized company as defined in clause 2E of the Companies Accounting Standard Rules 2021. Small and medium-sized company means a company whose equity or debt securities are not. If you see this definition, it is very similar what we have learnt in India's. Okay, whose equity or debt securities are not listed or not in the process of listing on any stock exchange, whether in India or outside India, which is not a bank, financial institution, or insurance company. Why they have excluded this? Because it is a specific company where their formats are different. Okay, that is why it is specifically excluded here. Okay, whose turnover excluding other income does not exceed 250 crores in the immediately preceding accounting year, which does not have borrowings including public deposits in excess of rupees 50 crores at any time during the immediately preceding accounting year, and which is not a holding or subsidiary company of a company which is not a small and medium sized company. Okay, these are called SMC companies. Okay, here if you see the explanation, for the purpose of class 2E, a company should qualify as a SMC if the conditions mentioned therein are satisfied at the end of the relevant accounting period. Okay, so this when you are starting the year 1st April 2024, for example, you have to do this analysis. Okay, not at that time, but at the 31st March. See, what they are saying is if the conditions mentioned therein are satisfied at the end of the relevant accounting period, not at the beginning. You have to do it at the end of the relevant accounting period. So when you are going for audit on 31st March 2024, then you have to see whether this particular company falls under SMC or not. You may ask me, sir, why once it is a company, we have to follow accounting standards? Why you are telling this division? No, it is, there are, in going forward, you will understand that all accounting standard or all clauses in the accounting standard does not apply to every company. Okay, that is the reason they have divided this to, see, there will be small companies. That is the reason they have given this benefit for doing, for easy compliance. Okay, that is the reason these companies that have been divided into SMCs and non-SMCs. Okay, this is with respect to companies. Okay, so once it is not SMC, so which is not falling under this criteria, by default it will become non-SMC, that we have learned here. See, SMC means, if I know, non-SMC is very easy. If it is not SMC, then it is non-SMC. That is the reason there is no definition for non-SMC. Only SMC there is a definition where the equity or securities of that particular company is not listed or not in the process of listing either in India or outside India, which is not a bank, financial, or insurance company, where turnover is does not exceed 250 crores, then it is SMC. And where the borrowings, including deposits, is between not in excess of 50 crores, then it is SMC, which is not a holding or subsidiary. If suppose that particular company is not a holding or subsidiary, which is not a SMC. Suppose if this particular company, which is not applying this all the four conditions, but it is the subsidiary or holding company of a non-SMC, then it will become SMC. Okay, this is what they have given. If suppose these conditions are not applicable, by default it will become non-SMC. Okay, now coming to accounting standards for non-companies. See, if you see here, corporate entities, non-corporate entities. Corporate entities, why we are dividing here, I am repeating because you will get confused. That is the reason I am repeating. Corporate entities, again, the standard, the preamble to the standards, they have explained, they have given the explanation saying that you divide the companies into two parts. Either it should be SMC or non-SMC. If it is SMC, then you have to follow certain standards with certain clauses. If it is non-SMC, you have to follow these clauses, or you need not follow these clauses, like that. Okay, that is the reason this division is happening. Now we are trying to understand if suppose if it is non-corporate entity. See, non-corporate entity and division has no relevance. Please understand, because the explanation should be in continuation. I have taken here non-corporate entities division also. Otherwise, division 1 financials is only applicable to corporate entities. It has nothing to do with non-corporate entities. Please understand. See, this division 1, what we are talking here, applies only to corporate entities. Okay. So for corporate entities, we have to divide the companies either to SMC or non-SMC. Once you decide, then you will understand which standard, which clause has to be followed, and accordingly you will disclose and present the financials as per division 1. This is done. Because I have to, in our syllabus or in our course, we have financials of non-corporate entity also. And this is with respect to applicability of accounting standard. I am covering that aspect also here. Okay. And this has nothing to do with division 1 financials. Okay. So for non-corporate entities, accounting standards, see, many people, there will be big, there are so many partnership firms, LLPs, we do audits, okay, individuals, whoever it may be. We are doing audits, but how many of us are reporting on accounting standards? Okay, whether it is individual or partnership firm or LLP, whatever it is, all accounting standards are applicable as stated here. Okay, for non-corporate entities, institute, see, company law has nothing to do with the non-corporate entities, right? So institute has specified, okay, institute has specified how you have to identify which accounting standards are applicable to which company and all. Okay, so institute has divided the non-corporate entities into 4 parts. That is level 1, level 2, level 3, and level 4. Okay, level 1, if you see here, level 1 entities are required to comply in full with all accounting standards. If that particular entity is falling under level 1, then by default, how many accounting standards are there? 1 to 29. All are applicable to that particular entity. Please remember. Okay. Sorry. We will understand what is level 1, level 2, level 3, level 4. Okay, and level 2, level 3, level 4 are referred to as micro, small, and medium size entities. Okay, you can see here how they have named also. This is not my own, it is all from Institute ICAI material. Okay, level 1, large size entities, level 2, medium size entities, level 3, small size entities, and level 4 is micro entities. And level 1, they have specified very clearly all accounting standards are applicable in full. That means there is no exemption to any clauses. Okay, whatever is clause is given in any of the accounting standard, it applies to level 1 entities. So now we will understand what are level 1 entities. See, this is again same criteria. Whatever we have done for Ind AS, whatever we have done for companies, here also for non-corporate entities also the criteria is almost with the same ranges. I mean, whatever the criteria specification they have given is same almost. See, here on the left hand side, I have given as it is. See, these things I should not do my own language and all. That is the reason I have copied as it is from the institute, okay, or from material. And here I have just put for your easy understanding in short form. Okay, what you see on left hand side is the extract of the statements which are given by the institute. On the right hand side, this orange boxes which I have put it for easy learning. Okay, listed or in the process of listing in India or outside India, banks including cooperative banks, financial institutions, and insurance business. Turnover greater than 250 crore preceding accounting year. Borrowings greater than 50 crore preceding accounting year. Holding or subsidiary entities of any of above. Okay, in these cases, then they are called level 1 entities. Here, then level 2, level 3 is in the same lines only with different ranges. That is turnover 50 crore to 250 crore and borrowings 10 crore to 50 crore and holding on subsidiary, then it comes into level 2. If turnover is more than 10 crore but less than 50 crores, because from 50 to 250 it is there in level 2. Okay, borrowing 2 crore to 10 crore, here up 10 crore and 50 crore. Okay, holding our subsidiary of the company, then it is level 3. And level 4, non-company entities which are not covered under level 1, level 2, level 3 are considered as level 4 entities. Simple. Okay. So if you know level 1, level 2, level 3, then whatever is not falling in level 1, level 2, level 3, then by default it comes under level 4 entities. And they have given some additional requirements that an entity covered in level 2, level 3, level 4 may opt for availing certain exemptions. There are certain exemptions, explanations which are given. Okay. This is the summary of what all the clauses applicable for various level entities. Okay, see, level 1 they have not given, reason being everything is applicable, so there need not be any again column for it. So they have given level 2, level 3, level 4 entities. Accounting standard 1 applicable. Okay, accounting standard 3, okay, is not applicable for all the level. See, either level 2, and so did you prepare any time cash flow statement for any partnership firm? You would not have prepared, right? Because it is not applicable only. Same way, if you say accounting standard 10, for level 2 entity it is applicable. Level 3 entities applicable with disclosure exemption. They have given, okay, it is applicable. So whatever you are following the accounting process and all, you have to follow it, but you need not disclose it. Okay. Same way, level 4 entities with disclosure. See, here they have given some clauses also, only applicable for, I am talking about accounting standard 22, applicable only for current tax related provisions. Okay, not for, I mean, deferred tax like that. Okay, here 23 not applicable. Refer note 2D. Okay, they have given the explanations where they 2D and all, in that particular book it is available. So they have given the exceptions where it is applicable or not applicable. So they have given which clause is not applicable for that particular entity. Those details they have given here. Okay, this is how the accounting standards are made applicable to various entities. So in today's class, we have learned what are Ind AS, IFRS, and accounting standards applicability to corporate entities and non-corporate entities. Okay. Now I will show you the format. I will just show you. We will not discuss that today. We will discuss in the next class. See, this is the extract which I have taken from Companies Act Schedule 3. Okay. These things, I don't want to put my terms and all. We have to read line by line as per the standard, and we have to follow it strictly. Okay, there is no, nobody can put their own mind here, because they have given clear instructions how you have to follow. Okay. So if you get any doubt, suppose if your senior says you do this way, you can go here and refer why he is telling you to do that way only. You may tell, sir, this is also coming in current assets, that is also coming in other current asset. What is difference? Why you are asking me to remove from here and put it? There is a meaning for it. See, your senior is not telling just on his own. It is not his passion to put it from current asset to other current asset, or from other current asset to current asset, because he is following this particular format. That is the reason he is telling you. Okay, and this is prescribed by the MCA. Okay, so we have to follow this line by line. So this is the reason I have copied this. I mean, I have downloaded this from the Companies Act, and we will see. This is the 1 minute. This is, you see here, we have told about divisions, right? You see here division 1, schedule 3, division 1. What it says: financial statements for a company whose financial statements are required to comply with the company's accounting standards, right? Now I will show you, this is where you see, this is the part 1 balance sheet, where it is starting with equity and liabilities, fine, and next followed by assets, correct, in vertical form. Then part 2, these are all instructions, okay, which we will go through. Okay, today I'm just showing you the format. Okay, then P&L statement of profit and loss has started, fine. This is revenue, operations, other income, then expenses, okay. Then general instructions. Now you see here division 2. I will share this also, don't worry. Division 2, okay. This I have not prepared anything, I have just downloaded from Companies Act. Division 2, where you see financial statements for a company whose financial statements are drawn up in compliance of the company's Indian Accounting Standard Rules 2015. Okay, this is what we told. This format is applicable only to the companies where Ind AS has to be followed. If you see here Ind AS format, wherein earlier division 1, liabilities were there. But here, first is assets. That is the major difference. I told you I will highlight wherever there are major differences between Ind AS and in accounting standards. This is one of the important aspect. If you have invested in any shares or something, you get annual financials. Then you see if their balance sheet is starting with assets, means then they are following Ind AS by default, you can say. Because if they are following accounting standard, then it is first is liabilities, then is assets. If they are following Ind AS, this is a blind way of remembering. Okay, assets first is assets, then is you see format, then liabilities. You see equity and is coming next. Okay, and profit and loss statement, then general instructions. Okay, then profit and loss statement of profit and loss there. Then I will just show you division 3 also. Part 2, statement of profit and loss, revenue from operations, expenses. Okay. You see here division 3. Financial statements for a non-banking financial company whose financial statements are drawn up in compliance with the company's Indian Accounting Standard Rules 2015. Okay. These are the 3 divisions which are prescribed by MCA, Companies Act, which has to be followed by respective companies. And the criteria to decide which division has to be done, it depends upon the applicability of accounting standards, which we have understood in this class, that if this particular turnover of the company, listed, unlisted on India, outside India, borrowings of the company, that criteria, if it is matching, then Ind AS has to be followed. If not, it will come to normal accounting standards. Okay, I think you are clear. If you have any doubts, please post it. I will share in group these 2 formats so that you can refer when I am taking further classes. Then we will work on 2-3 financials. We will prepare complete financials as per division 1. Okay, can we conclude?
Okay.
Okay, thank you.
Thank you.